Let's break down what this jobs report means for stocks after the major averages fell from the record highs they set earlier today. Joining us now is Ross Mayfield. He is an investment strategist at Baird Private Wealth Management. Ross, it's great to have you on. Given what we've seen in the data, not only today, but this week, what we're seeing in the bond market, do stocks hovering right near record highs, does that make sense, or are we looking at maybe a near-term peak here?
No, I think it makes sense. I mean, look, it wasn't a perfect report today. But people are still working. I mean, the unemployment rate is still historically low. People are not being let go. Initial claims are down. And as you mentioned earlier, wage growth is still above inflation. So it's fueling consumer spending. We see consumer stocks, equal weight discretionary, right at all-time highs, which to me is a sign that maybe the narrative about the economy is not nearly as dire as it's being painted. And instead, the market is painting a picture of a consumer that's doing decently and looking forward to a couple of rate cuts this year as well.
That's pretty interesting activity, trading activity under the hood here, because not only did you have tech, especially stuff that's tied to AI, taking it on the chin today, but you had some of the more cyclical sectors like energy and financial selling off as well. We don't see that dynamic a lot. What does it tell us?
Yeah, I think the message is that that investors are a little bit worried about the economy here. It's a bad news or bad data is bad news, not the other way around. The job market, as was mentioned earlier, has been the primary driver of the economy, of this bull market, the consumer spending coming out of the COVID-19 pandemic. So it's very, very important to keep the job market afloat. I think today, the rotation out of cyclicals a little bit, despite, again, being at all-time highs just earlier this week, is a sign that investors are slightly concerned about the labor market picture and the idea that the Fed is behind the curve, that 25 basis points in September might not be enough.
Ross, I'm concerned after a few earnings reports lately about what retail might be telling us about tariff costs bringing pain in Q4, maybe not to consumers. I mean, if discounting is really required during the holiday season to move inventory and keep consumers in the game, I mean, that could be a real margin twister, couldn't it?
Yeah, it could. I mean, look, we're watching the consumer stocks very closely to see what level of prices they're going to pass on to the consumer and what level they're going to try and eat. But at the highest of high levels, the S&P 500, aggregate margins are hovering near all-time highs. I mean, we're seeing, we got productivity data revised higher this week. I think we're starting to see a nascent productivity story. It might not be all AI. But companies are just very, very good at managing uncertainty. And so while the narrative is that, hey, we'd love to know the tariff picture, we'd love to know the rate picture, that level of certainty is just not going to be around the corner. In the meantime, companies are printing record earnings and margins are actually on the way up. So consumer stocks are again, trading at all-time highs. You're seeing things like home builders kick in. You're seeing things like retail, leisure, hospitality do well. So I actually think that the narrative is that the consumer picture is okay, and we'll probably have a decent to good holiday season if I had to place money on it.